Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, learning entry-level economic terms, part 2 in our series on basic education for financial literacy, sponsored by LifeSize Solutions and the Society for Financial Awareness. Well, welcome to our second segment. We're trying to educate ourselves with basic financial terms and walk through some ideas. But before we get into the deep part of that, let's talk about the 8 key ingredients to your investment cake. If I was a baker, if I was a chef, I'm not either. But if I could put it in culinary terms, here's what I'm looking for to bake what I think is going to be a good lifestyle using my money to support it. Time frame. Is it short, mid-term, long-term, or lifetime? I need to know what my investment postures are, what are my goals, what are my strategies, how long. And remember, you should go out on the web and take a life expectancy test to get a good idea. Remember, the Wall Street Journal published an article a couple of years back that said basically these things. Males will average 86.8 years, females 88.8 years, and the survivor of a marriage, generally the wife, 87% of the time, she will average 93. Now that's the average. That's not just some outlier. Number 2, tax consequences. What's going in and what's coming out. I need to know. Everybody always says, my biggest bill is my mortgage. Maybe not. It could be taxes. Ordinary income tax at the federal and state level could be taking your money. I mean, you just have to look at what's really causing it. Is there any way to mitigate that during accumulation? We really have to manage this issue during retirement. Number 3, diversification. We need to really lower our risk. Part of lowering our risk is diversifying and trying to get to different structures. If you haven't taken a risk tolerance test yet, even though there's not really a test that's totally science, it's definitely an indicator and can put you in the game and get you an understanding of what you should do and where you should be. Then you want to do liquidity. I have to have some money on the side. I can't put it all in qualified plans. I can't put it all in my mortgage. I can't put it away all for college education and retirement. I have to have some loose change money. What if I lose my job? What if I have an unforeseen expense? So I need to have money on the side. Most people say 3 to 6 months is a good place to have an emergency fund and have liquidity so I can actually jump on an investment. Another thing, ability to have long-term perspectives. I need to think about long-term retirement. When I was younger and I went through the 1987 crash in October, I have to say I was disconcerted, but then I had 30 years in front of me. So it wasn't as bad as I thought it was, and I didn't want to take my emotions and my feelings and let them be caught up in the downward trends that hit my portfolio at that time. Not becoming sentimental. Well, I got people that said my father gave me the Anheuser-Busch stock. I can never sell it off. And really, that's the very thing they should sell off. The profits are huge right now. They've done really great. Now, the expectation, they're really not on the buy list. Not Anheuser-Busch, I'm just using an example. And all of a sudden, there's too sentimental. They've been holding too long. The big 3 investment tenets: buy low, sell high, and hold when in doubt. I don't know about the hold when in doubt. Sometimes I say there's a little bit more management issues there, but you should always try to come and be a little bit, what can I say, taking profit off the table. A bit greedy here. When you're doing well, take a little off the table and start to train yourself to do so, and then buy when the market's down lower so you can buy your stocks, bonds, mutual funds, and ETFs at a lower cost. And having a specific investment plan. I have to have a plan. Without a plan, I don't know how I can get this done. I cannot wing it. It's not a do-it-yourself issue. I have to have some help. Let's examine a few facts. Market declines happen. They just do. There have been a number of bear markets over the past 30 years. Oh, don't I know it. However, the overall long-term trend has always been up. Now, don't be fooled by the Ibbotson chart. It's a good chart. It shows always increasing, but there are pockets there, and depending upon when you retire, what if you're in front retiring at 2000? Think about that. Your first 10 years, there were 4 loser years in that decade, the lost decade. So sometimes corrections are good for the market. Corrections tend to be shorter and less severe than bear markets. That's usually why investors refer to them as buying opportunities. You have to set your mindset. It seems to be negative, but now it could be positive for my portfolio. Note, most often the market's wrath descends on companies with very high stock prices relative to their earnings, or to business concepts that look great in the euphoria of the moment and the booming market, but in the end appear to have very little fundamental support. And of course, that's where you need a good advisor that understands the market. This is a snapshot of the S&P starting in 1928, right before the crash, and all the way out. Now, the only thing I'm concerned about, so I can get you to understand this, is Outside the great crash in the late 20s, the next really what I would call severe bear market happened in the lost decade between the years of 2001 and 2010. 2001, 2, and 3, and 2008 were negative markets in the S&P 500. Now, we're just looking at where this happened. So you can see that sometimes there's going to be some tough times. Look at that 2008. That was a tough time. In our modern era, most of us who didn't go through this. Our great-grandparents and our grandparents went through it, but none of us have went through it. So it's really critical for us to think about how to take money off profits on the table, park that money, or buy low when we're having terrible markets. Keep buying at the lower end to try to get your price and your shares as low as you can to purchase them. Let's examine a few facts. Fact, market timing doesn't work. In an ideal world, we would all time the market and pick the winners by pulling out money when it peaked and would be investing again at the bottom. Hardly anybody knows how to do this really well. Some of the anomalies are out there, people who promote that they can do it. I just don't know if that's really true. 95% of all the financial advisors, market watchers, and people of substantial authority written in Wall Street Journal, Forbes, Fortune Magazine, Money Magazine, all these magazines say market timing is really difficult and we shouldn't be caught by the allure of it to try to invest our money. Why? Because we only know the peaks and valleys in hindsight. I have a rear view mirror. I can look into the past. I can look at the timelines that happened, what has occurred. I just can't predict what will occur. I don't think anybody that has great prophetic insight. Nobody's got a crystal ball. You can look at some technical strategies, you can look at some mechanical strategies, a little bit historicity, but none of this in the end is going to be able to predict it. An opinion, staying invested and sticking to the plan asset allocation model has historically beaten timing hands down. And then there's just a small little graph. 6% of security selection is one of the reasons why you do well. 2% of the market is timing. 1% is factors. Those are just three small areas to depend my future and my portfolio from performing. So asset allocation 91% of the time is the better deal. You should get used to it. You should get good with the terms on it. Those are good things to know as an investor. Fact, many of us find it difficult to invest when the market is down. It's just emotions. We have to become disciplined and passionate investors. This impedes our accumulation planning goals. Based on market turmoil and media hype, we choose behavior to stay on the sidelines, waiting for the right time to invest. And after 2008, so many boomers, including myself, were afraid to move back into the market. We didn't know if the purge was finally done. So it's hard and it's really difficult. And there's a mindset. And remember, without a risk tolerance test, I don't know if I have the psychological makeup to go through another one. So you need to take those into account. You can formulate a long-term plan, how much to invest, how often to invest, into which investments. You have to know this for yourself. And remember, you need to allow yourself to invest regularly. Some people use dollar cost averaging to get this done. A dollar cost averaging, I'm putting the same amount of money in every month, whether the market goes up, whether the market goes down. It's not pure science. It's just a mechanical habit. It's a good habit. It's a good discipline. It's good behavior. I'm just regularly investing. I'm not trying to hit the market on timing it. I'm taking some maybe money off the top when I do well and park it on the side, preserve my profits. But bottom line, day in and day out, most Americans, most of the middle class, should basically look at dollar cost averaging as an option in their investment strategies. Fact, measuring true performance in a bear or bull market can be done in different ways. Beta, the investment's volatility to the market's reference. In this case, we're using the S&P 500. So is the beta, do we expect to make more than the S&P 500? And am I willing to risk principal? That's what you have to start in mindset. Principal to actually beat the S&P 500. If I don't think that, you may be looking at, you should buy indexing. Maybe you should do S&P 500 index. Cheap, easy to understand. 500 companies are represented. You don't have to micromanagement. The costs are low. And overall, it's done a pretty good job in history. But if you say, I'd like to beat the market, then you got to look at the beta risk. What's the risk and volatility on my principal? I need to know the standard deviation, a measurement of the portfolio's total risk. When I look at everything I have in asset allocation, what's the number? What's the risk factor going into a market? Listen, we've had great markets in the last 6 to 8 months for this, especially post the election. You have to start thinking, hey, should I start taking profits off the table? Because I don't want to be in a situation where I'm going to have a problem and watch all my profits get lost in a correction or, worse than that, a bull market, a bear market. Technical analysis, I want to focus on supply and demand. I want to look at things like relies on timing. Now remember, this is if you're analytic, looks at market trends, studies past pricing and sales volume. It emphasizes market influence rather than economic influence. Remember, the market's influenced by things. If we're hip to everything that's going on in the global community, as an investor, especially people who manage money, this is a big emphasis, an emphasis on economic data. The big three of companies' health, it's productivity, it's profitability, and of course, it's earning potential. Those are the things that are in the mix when you're looking to go ahead and construct a basic mindset so you can approach and build your portfolio out. Don't forget to watch our next segment on the theory of asset allocation, part 3 in our series on basic education for financial literacy. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.